Hello, in this video, we're focusing on the practical concepts that you can actually apply in the real business world. Hope you enjoy it. Let's get on with it. Welcome, everyone. Today, we'll be exploring how to successfully identify, originate, and execute acquisitions, specifically for founder-led companies and small to medium-sized enterprises. Acquisitions require careful strategy and thoughtful decision-making, much like playing a game of chess where every move can influence the outcome. We'll cover key steps and best practices to help these types of businesses navigate the process smoothly and effectively, aiming for growth that aligns with their unique goals and values. Acquisitions can be a powerful way for founder-led companies and small to medium-sized enterprises to grow quickly by gaining new customers, skills, products, or market access in a much shorter time than organic growth alone would allow. However, these smaller businesses often have fewer resources and smaller teams, which means they face specific challenges like limited capacity for due diligence and integration, and a greater emotional connection from founders on both sides. Success in this context comes from focusing less on complicated financial structures and more on carefully finding the right opportunities and executing deals efficiently and clearly. Having a well-structured acquisition process helps keep the business focused, aligns with the founder's strategy and values, and improves the chance that the acquisition will add real value. This presentation will walk through a practical, step-by-step guide tailored for SMEs, covering how to identify promising deals, carry out the transaction, avoid common mistakes, and manage integration effectively, supported by real examples to highlight typical scenarios and the pros and cons involved. Acquisitions for founder-led businesses often unlock value through a few consistent synergy drivers. On the revenue side, growth can come from cross-selling products or services to each other's existing clients, such as when a managed IT firm acquires a cybersecurity company. Expanding distribution channels is another way, whether it's gaining access to new resellers, e-commerce traffic, or business-to-business networks. Acquisitions can also offer a faster route to enter new geographies, allowing companies to establish a presence without building from the ground up. Additionally, bundling products to create more comprehensive solutions can attract and retain customers. However, it's important to remember that realizing these revenue synergies usually takes longer than planned because it involves aligning sales teams, setting up incentives, training staff, and maintaining clear communication with customers. When it comes to cost synergies, these often feel more within a company's control. Savings arise by consolidating suppliers, warehousing, logistics, and back office functions like finance and human resources, although this must be done carefully in founder-led businesses where personal relationships matter. Combining forces also increases purchasing power. Still, sensitivity to company culture is critical, especially if the acquired firm is also founder-led, since maintaining trust and morale can impact how smoothly these savings are achieved. Overall, these synergy engines explain why many SMEs pursue acquisitions as a practical way to grow and improve margins. Acquisitions can help a company quickly gain important skills like design, data analysis, engineering, or regulatory knowledge without having to hire and train slowly over time. They also allow business to obtain valuable licenses, certifications, or approvals that might otherwise take years to develop. Additionally, acquisitions can bring in unique intellectual property, patents, or proprietary methods that strengthen the company's position. Strategically, acquiring another business can neutralize competitors, secure key supply chain elements, or diversify the customer base to reduce risk. For founders, acquisitions can support building a larger platform for future growth, attract investors by showing scalable potential, and reduce dependence on the founder by creating a stronger leadership team. Together, these factors highlight why acquisitions are often a practical and effective way for small and medium businesses to grow and defend their market position. Finding the right acquisition deal is more about being proactive and strategic rather than competing in auctions. It starts with a clear deal thesis, which is essentially a one-page summary that outlines why you want to acquire, the type of business you're targeting, the critical factors that must be present in the target, and any deal breakers to watch out for. This helps keep your focus sharp and prevents you from chasing opportunities that don't fit your goals or drain your resources. Once that's set, the next step is to build a target list of around 10 to 50 companies. This list should be based on various sources like trade associations, LinkedIn referrals, competitor maps, and local advisors. Each target is then scored on things like strategic alignment, financial health, cultural fit, ease of integration, and potential synergies. By doing this systematically, you position yourself to identify and approach the best opportunities early, build trust with owners, and create deals that make sense for both sides. When choosing how to find acquisition opportunities, SMEs often combine several approaches. Proprietary outreach, where founders connect directly with other founders, tends to offer the highest return if done well, because it creates a more personal and trust-based relationship. Using corporate finance advisors or brokers can be helpful for managing the deal process and increasing deal flow, but this path tends to be more competitive and might come at a higher cost. Network-led sourcing is another effective channel, leveraging relationships with board members, accountants, private equity networks, or suppliers who may have insight into potential deals. Some businesses also bring on a part-time acquisition lead or fractional M&A professional to manage and build a pipeline internally. It's important to keep outreach respectful and human, since sellers who are also founders usually respond better when the conversation focuses on shared values and vision, rather than just financial figures. This founder-to-founder respect sets the stage for a better connection and a more successful origination process. When you're on early calls with potential sellers, it's important to quickly get a sense of what motivates the owner, whether they're looking to retire, grow the business, plan succession, or reduce risks. You also want to understand the financial health of the business by asking about things like revenue, EBITDA, how much of the income is recurring, and if they have any significant customer concentration. Another key point is to gauge the strength and stability of the team, especially if the company relies heavily on the founder. Also, keep an eye out for any obvious deal breakers such as legal disputes, regulatory problems, or weak cash flow. The approach here should be about finding a mutual fit rather than conducting a tough interrogation, which helps build trust and encourages openness. Moving to deal structuring, SMEs often succeed by using creative approaches that share value and risk between buyer and seller. Common methods include earnouts based on future revenue or profit, vendor loan notes where the seller finances part of the price, staged acquisitions where the buyer purchases a majority share upfront and the rest later, management incentives to retain key people, and equity rollovers that let the seller keep a minority stake. These tools can lower upfront cash requirements, align incentives, protect against overpaying, and smooth the transition for the founder, making the deal work better for both sides. Execution is the critical stage where deals are either secured or lost, so running a clear and professional process is essential, especially for SMEs. Before making a formal offer, it's important to prepare by building a high-level financial model, considering both the base and downside case, identifying the key diligence questions that must be addressed, planning out financing options like cash, debt, or deferred payments, and deciding how integration will work, whether absorbing the business, letting it operate standalone, or a mix of both. This preparation should lead to a clear internal investment memo, which doesn't have to be formal, but must be thorough. When moving to the LOI or heads of terms phase, the approach should be fast, clear, and fair. The strong LOI outlines the price range and payment structure, sets assumptions for working capital, specifies the exclusivity period, usually between 45 and 90 days, and lists clear conditions such as due diligence, financing, and board approval. It also covers expectations around retaining management post-transaction. A practical tip here is to avoid overly long exclusivity periods if diligence resources are limited, to maintain momentum and keep the deal moving efficiently. Due diligence in this phase should be focused and thorough where it matters most. On the commercial side, it's critical to understand customer concentration and churn, pricing power, margin stability, the quality of the sales pipeline, win rates, and how the business stacks up against competitors. Financial diligence requires a close look at the quality of earnings, including any one-off items or own add-backs, cash flow patterns, working capital dynamics, revenue recognition, deferred income, and potential tax issues or liabilities. Operational diligence should cover key processes, bottlenecks, supplier dependencies, IT systems, cybersecurity, data integrity, and any capacity constraints in personnel, facilities, or logistics. Legal diligence focuses on contracts, particularly change of control clauses, intellectual property ownership, employment matters, litigation risks, and regulatory compliance. Lastly, people and culture diligence, often underestimated, involves identifying who truly runs the business, understanding the impact if the founder departs, assessing incentives, retention risks, and potential cultural mismatches. In founder-led acquisitions especially, getting a clear picture of the people and culture is often the most important factor in ensuring success. When it comes to valuation and negotiation, it's important not to rely only on EBITDA multiples. Instead, focus on factors like the quality of the customer base, whether revenue is recurring or project-based, the stability of gross margins, the level of reinvestment needed for capital expenditures or hiring, and the costs and time required for integration. Also, consider risks such as customer concentration and key person dependency. In negotiations, prioritize the price and deal structure to share risks fairly and be clear on representations and warranties to protect against any hidden problems. Indemnities should address specific known risks and make sure arrangements for retention and transition are in place to keep the business running smoothly. Non-compete and non-solicit agreements help protect your investment's value. Financing. Look for options suited to SMEs. Using cash reserves is simplest but may impact liquidity, while bank debt and term loans require reliable cash flow and adherence to financial covenants. Asset-backed lending can work well for businesses with lots of inventory or receivables. Vendor financing can align the seller's interests with deal success, and private investors or minority private equity partners can bring capital expertise but may reduce control. The key is to maintain operational flexibility, since many SME deals fail not because the target was weak, but because cash flow gets squeezed after the deal due to debt payments and integration costs. Once the signing is complete, it's important to communicate clearly with both customers and staff. Share a simple narrative that reassures everyone about continuity, highlights the benefits of the transaction, and clearly states who to contact with any questions or concerns. At the same time, focus on day one readiness by ensuring payroll systems are set up, IT access is granted appropriately, reporting lines are clarified, and any branding decisions are finalized. Don't forget to confirm any necessary regulatory or third-party consents to avoid delays or issues after closing. This approach helps create a smooth transition and builds confidence among all stakeholders as the transaction moves from signing to completion. Integration is the stage where the real value of an acquisition is either built or lost, especially for smaller businesses. The first 30 days are about stabilizing. This means keeping key people motivated with stay bonuses and clear roles, making sure customer service stays consistent, setting up weekly integration meetings and regular KPI reporting, controlling cash flow tightly, and constantly reinforcing the reasons behind the acquisition to everyone involved. From days 31 to 60, the focus shifts to aligning and simplifying. This includes merging supplier lists and tools to cut overlap, standardizing pricing and proposals, adjusting sales incentives to match the new goals, and starting pilot cross-selling efforts with your top 20 accounts. Finally, in the 61 to 100-day window, it's about scaling synergies by integrating key systems like CRM and accounting, streamlining the product or service range, setting up monthly performance reviews to keep everyone on track, and launching joint marketing campaigns. It's important to avoid trying to do everything at once. A phased approach helps minimize disruption and protects value throughout the process. A regional managed services provider acquired a small cybersecurity firm to address growing customer demand for security services. This acquisition brought immediate new capabilities, allowed for premium pricing, and helped reduce customer churn. The key to success here was retaining specialist talent through stay bonuses, integrating security offerings into managed contracts, and training the MSP sales team to sell these bundled services effectively. Importantly, they avoided the common mistake of over-integrating too quickly, which can lead to losing the cyber team. In another example, a founder-led niche manufacturer bought a smaller competitor that had complementary machinery and a strong local customer base. This deal created value through better purchasing power, streamlined production scheduling, and improved capacity utilization. Key execution points included clear communication with customers, aligning quality standards, and consolidating suppliers. A frequent pitfall avoided was underestimating the working capital needed during the transition, which often causes operational disruptions. These real-life examples show typical patterns in SME acquisitions and underscore the importance of careful planning and execution to protect and create value. In one example, an accounting firm acquired a smaller practice because the founder was ready to retire. This move quickly increased their client base and strengthened their presence in the local market, while also creating opportunities for additional sales. The success here hinged on having a clear plan to transition clients smoothly, keeping the existing relationship managers to maintain trust, and structuring the deal with payments tied to how well clients stayed with the firm. This approach helped avoid the common mistake of paying everything up front without protections for client retention. Another example involves an e-commerce brand acquiring a smaller company with a similar customer base and strong product reviews, but weaker operations. The combined business benefited from shared warehousing, joint marketing efforts, and better product economics. Key to success was carefully migrating fulfillment processes, consolidating advertising accounts without disrupting performance, and preserving the smaller brand's unique voice to avoid hurting conversion rates, which can happen with rushed rebranding. Both cases show how thoughtful execution safeguards and enhances value in SME acquisitions. Acquisitions can help a business grow quickly by bringing in new revenue, customers, skilled talent, and capabilities all at once. This growth boosts your competitive position and makes your business more resilient by scaling operations and creating differentiation. Spreading overhead costs across a larger base increases efficiency, and acquiring experienced leaders and specialists strengthens your team. A stronger business also opens up more strategic opportunities by attracting better partners, investors, and deals. However, there are risks to keep in mind. Overpaying is a common mistake, especially in competitive markets, and integration can distract leadership from running the core business effectively. Cultural differences between organizations can lead to tension and employee turnover, while losing key people can quickly erode value. There might also be hidden liabilities, like tax or legal issues, discovered after the deal closes. Taking on debt to finance the acquisition can limit flexibility and increase risk, and expected synergies, especially revenue gains, may not always materialize without careful planning. The key is not to avoid acquisitions, but to manage them systematically, focusing on better deal origination, thorough diligence, smart deal structuring, and disciplined integration to protect and create value. For founder-led companies and SMEs, acquisitions shouldn't be seen as one-time events, but as skills you develop and repeat. The most successful acquirers start with a clear idea of what they want from a deal. They find opportunities that others don't see by building trust with sellers, often other founders, which creates unique openings. Once a deal is underway, they stay disciplined, doing focused due diligence, sharing risks in sensible ways, and following a practical integration plan, especially during the critical first 100 days. When done well, acquisitions can speed up growth by quickly adding new customers, skills, and resilience to your business. But if handled poorly, they can drain resources, unsettle your team, and distract from running the business. The key difference lies in having a solid process, thorough preparation, and a clear plan for creating value. By intentionally building a pipeline of deals and executing thoughtfully with both rigor and empathy, you greatly increase the chance that each acquisition will strengthen your company and build lasting value over time. If you found this video useful, there's plenty of more business and finance videos on the channel that you'll enjoy watching and get great practical value from. In the meantime, thanks for watching.